What do ambitious young students and professionals dream about at night? The ones with average ambition levels dream about a job at a top-tier management consulting firm or investment bank. The ones with higher ambition levels dream about a job as an investor in private equity or venture capital funds. The most ambitious ones, Patrick Bateman level, dream about being an investor through starting and leading their own fund in public or private equity.
There are young traders out there who dream of running their own hedge fund.
That's how people like Steven Schwartzman or Mark Andreessen rose to be the giga Batemans they are today. That's the path to vast money, power and maximum prestige. Or is it? In the last 2 decades and since the financial crisis in 2007 and 8, the rules of the game have been fundamentally changed, with most young ambitious people still playing by the old rules. Both in private and public markets, performance of funds has been bad because excess fiscal stimulus and excessive money supply growth have created an environment in which too much capital is chasing too few investment opportunities. On top, the opportunity costs to engage in a traditional finance career are higher than 10 years ago.
We are currently going through one of the biggest transformations in financial history, the fintech revolution. And it's going to transform banking as we know it.
Both fintech startups as well as DeFi ventures have started disrupting incumbents in finance, sometimes going as far as allowing you to create a VC fund or a hedge fund through one simple click, like the crypto platform Hedge. Becoming and being an investor in high finance, be it public or private equity, is not what it once was, and finance fanboys are in for a rough awakening. We are going to look at whether or not working in hedge funds or VC is still a good career move. Should your ultimate goal really be to start your own fund if you are chasing money and power? What would Paul Allen do? And what new players are emerging? What new opportunities to achieve your megalomaniacal ambitions are we seeing? Typically, there are 3 types of people looking at the hedge fund or VC industry as a career choice. The first type of person came straight out of a prestigious college. So we are talking about at least mid-tier Ivies like UPenn or Columbia, but more likely Harvard, Yale, Princeton, or equivalent European universities. They are part of a small cohort of giga chads and chaddises with perfect bulge bracket and MBB internships and extracurricular such as being a chess grandmaster or having single-handedly saved the Amazon rainforest, earning them the right to be considered for a career in these industries straight out of university.
It's hard if you're not super competitive, I think, because you're going to be surrounded by highly competitive people.
The second type of person spent some time working in management consulting or investment banking or a similar job that somehow qualifies them on paper to join a venture capital or hedge fund. These people did great internships, went to prestigious universities, but were not quite sure where to go afterwards. They chose the generalist paths as investment bankers or management consultants. After 1 to 3 years, they realized that their current job is never going to enable them to launch a hostile takeover bid on Twitter. So they set their eyes on VC or hedge funds. The third type of person have already started a startup in the past or are some kind of other market wizard kid. Think Martin Shkreli.
More legal trouble for the so-called pharma bro Martin Shkreli, who's been serving 7 years in prison for securities fraud.
Founding Ilia Capital at the age of 13 or so and being sued $2.3 million by Lehman Brothers. Or Bill Ackman, starting his own fund straight out of business school.
Actually, my father, who's here, he told me it was a really dumb idea to start an investment fund right out of business school. And he recommended that I go work for Michael Steinhardt or George Soros or one of the other famous investors at the time.
No matter who you are among these 3 types, this video is for you. Now, among these elite chads and chaddises, there's 2 types of ambition levels. Normal human being ambition level. They simply want to work in a fund first. It comes with a lot of prestige and good money, and they can always figure out their next big steps later on. Life is long enough, right? Right? No, the second ambition level is Bateman-like megalomania level paired with extreme competitiveness.
We really like competitors. Someone who won't lose doesn't lose.
These are the people that want to have their own fund. Then they want to have their own jet. And lastly, they want to have their own basketball team. No matter which attitude you identify with, the narrative for all of them is flawed. Because here's the thing.
And what I came to find was that I think the nature of the financial system in the US has changed profoundly over the last 40 years.
There are certain dynamics that have developed in the investment industries, be it private or public markets, that most business schools and media don't talk about enough. There's a money problem, and there's a problem of opportunity cost, meaning there's more alternative options arising to traditional funds. Firstly, let's talk about money. Most investors generate extremely average returns on the money they are managing, irrespective of whether you look at hedge funds trading public equities or venture capital funds investing in private startups and growth companies. Hedge funds' performance has been...
Goldman Sachs' basket of the 50 names that appear most often among the top 10 holdings of hedge funds, its so-called VIP list, returned just 11% last year. That's about a third the return for the S&P 500.
Not so good. And something similar is true for venture capital. VC returns are governed by the power law curve. This means that a small percentage of VC funds take home a large percentage of venture returns.
It's only the tail that you care about. It's only the extreme event that matters.
VCs are constantly working to make their way into the winning part of the curve, so they can continue to attract capital from limited partners. The majority of funds have a hard time, even more so as the valuations on public markets are being compressed, aka they are Listen to what Brad Gerstner, founder of Altimeter Capital, one of the few investment firms that are still winning, has to say about valuations of portfolio startups of VC companies.
It's going to be very painful. I think that Sachs's point about down round IPOs, I don't think this is the exception, David.
Some viewers might be inclined to say, what do I care? I'll just be an employee that receives a fat salary. It doesn't matter. Wrong. The fund performance is often directly tied to your bonus payments that can be responsible for as much as 50% of your compensation as an employee. Even worse, if you dream of starting a fund, it will be extremely challenging to be among the top 1% of funds that do extremely well.
Considering that there are more than 10,000 hedge funds, this means that the top 0.1% of hedge funds by size control more than a sixth of all funds under management by hedge funds.
Statistically, it's more likely you'll be in the bottom bucket. And since you derive a majority of your income as a function of the fund's performance, you might have been better off working towards MD in monkey business, aka investment banking or private equity, and pocketing a boring but safe $1 million salary as an employee. Before some of my subscribers and 90% of Wall Street Oasis members start crying and getting panic attacks, this does not mean hedge fund or VC is a bad career move, but it means that the odds are stacked against you if you want to stay there for a long time and become massively successful, aka rich. Depending on your personal master plan, it might be worth working there for 2 to 3 years, but it will be turbulent times because here's the next problem. The opportunity cost to working in these traditional finance industries have become extremely high with the advent of fintech and crypto.
Crypto is on the verge of revolutionizing traditional financial systems. Advocates say it has the potential to make the current financial system more efficient, accessible, and faster.
Without being too much of a crypto bro, but if you only bet on these traditional finance career paths, you might NGMI.
The folks that came up with mortgage-backed securities, more quant end of crypto, you could read across to derivatives. And it's no surprise there are a lot of people are leaving big, what's called TradFi institutions and going into crypto. So people looking for those trillions of dollars get attached to crypto.
Most ambitious folks still fail to realize how the slow and steady rise of fintech and blockchain use cases will turn everything on its head. There's a very high probability scenario that the blockchain will permeate everything we do in finance, from collateralizing loans to managing assets such as on DHedge.
Massive creative power of DeFi is how quickly developers can iterate and build financial applications. That was really never possible in finance.
Here's 3 reasons why you might be screwed if you're only preparing for a traditional finance investing career. Firstly, with the rise of startups and Web3, another type of talent is valued. Suddenly, your Harvard MBA means nothing, but your ability to actually do the work, for example, read and write solidity, means everything. Secondly, hedge funds and venture capital funds have traditionally been a closed system for a small elite circle. For example, if you want to start a fund or you want to invest in a fund and become a so-called LP, there's high barriers to doing that, and it takes ages.
If you want to set up, say, a fund for these things, it would take many, many months of work. But because DAOs can be spun up so much more quickly, they can also be spun down so much more quickly once their purpose is done.
Are there structural issues, Ian? Are there governance issues that really still need to be worked out among DAOs when people are thinking about entering into them?
But what we are seeing through crypto and Web3 is a democratization of access to VC and hedge funds. Crypto platforms like Alien or D-Hedge are making it easy to become a fund manager or invest in some of the best performing fund managers out there, all while providing a much cheaper fee structure than traditional funds. What this means ultimately is that some of the old institutions will need to compete harder. There will be more money managers, more options to invest as an LP, and some old school funds will die as they fail to differentiate themselves. And lastly, DAOs.
Yeah, let's try to boil it down for you. Partially through the use cases, these are decentralized, autonomous organizations.
One of the biggest application areas of DAOs, in our view, is the area of investing.
One central hypothesis is that in the future we might have fewer traditional company entities and more DAOs that are owned and governed by the community, not a couple of powerful individuals.
The way we see investing moving is becoming dramatically more community-owned and dramatically more transparent and dramatically more accessible.
These structures fundamentally undermine the traditional investing business. If companies will be owned by communities in the future, how can traditional investment funds participate? So, should your goal absolutely not be to build your own fund one day? Listen. The only people making money in this business are the biggest 10% funds and their LPs. So if you are someone aiming to build a fund, it needs to be huge. Otherwise, you face terrible consequences. Firstly, the finance industry does not give you a second chance. If you underperform in Fund 1, you're burned, and it will be difficult to continue your finance career. Secondly, there's an oversupply of failed hedge fund managers who are looking for high-paying jobs, making it difficult to recover from a failed fund. Thirdly, building a traditional fund means tons of legal and admin fees, so you lose a small fortune in the process. But there's kind of a solution to all of this. A startup I reached out to some months ago is making it easy for anyone to become a fund manager or invest with the best fund managers. This means, firstly, you have less competition because few people are building their funds on the blockchain so far. Secondly, you have close to zero fees when setting up your own fund. And when investing in funds, you are able to invest with the fund managers for relatively low fees. Thirdly, and in case your fund is an utter failure, the decentralized finance community is much more forgiving than the traditional finance industry. So you'll be fine. Lastly, it's kind of nice not to be an asshole. It's not like we are usually virtue signaling on this channel. But if you can make more money while doing something good, that's a win-win in my perspective. Finance is such a closed-up industry. It's an elite circle of people moving the majority of this world's money around. And although we all dream about it at night, it's extremely difficult to break into this circle. So, democratizing this industry, giving more people access to high-performing, actively managed funds, all the while becoming insanely rich should maybe be high on your to-do list. The Web3 industry will mint giga-batemans that will get to billion-dollar net worths and mind-boggling levels of power. So would you want to try your luck in traditional industries with established masters of the universe? Or do you want to stir some shit up in an emerging industry where cards are being dealt right now? Both have pros and cons. So what would be my master plan?
You can really learn on your own. You can learn investing by reading books, by reading annual reports, by having you can have a portfolio and invest $100 and you can learn the business.
If you find venture capital or hedge funds or any other finance industry interesting, do the necessary internships and collect the badges on your CV to be able to work there. However, make a small note in your 10-year master plan to only work there for 2 to 3 years and not with the end goal of starting your own fund afterwards, but acquiring as much transferable knowledge as possible about the world of finance and business in general. Network with as many old and influential leaders as possible during that time, all the while getting up to speed on Web3 projects like Hedge, join communities and build your side income, which is so incredibly easy. Earning side income, for example, as a community manager in an exciting Web3 project, as I have advised one of my mentees in my Patreon community recently. And be ready to leverage your network of old and influential contacts from the traditional world of finance to build your own thing in emerging industries as soon as you have gained the necessary skills. The next revolutionary founder will not be like Mark Zuckerberg, and the next king of finance will not be like Stephen Schwarzman, but there is a reasonable chance they will be in a strongly growing industry such as Web3. Wagmi. Now, because we talked about Hedge so much, I want to take this opportunity and lead you through their website. They are, of course, also today's sponsor of this video. You simply click on Connect Wallet. Of course, that's the first step. And then I love the clean interface. I mean, you can see here all the different managers. So you can filter, for example, most value managed, who's the top ranked manager, top performing, and then you have different types of information here, like for example, how much value are they actually managing. Now next, you can go to your own investments. So if you decide to invest with one of these, you will then see them in your own investments and you'll have the full overview. And very interesting for all of us big dreamers, you can become a hedge fund manager with a couple of clicks. So let's say you want to use Polygon to set up your pool. That's how they call their funds. Okay, so now you need to find a nice name for your fund. We'll call it Gorilla Fund, symbol GOGO, and manager name, of course, me. We'll set the management fee to 2% to stick with the industry standard. We'll choose the assets that people can deposit or withdraw. That's good. Next. And create new pool. We'll just confirm that in MetaMask, transaction submitted, and success. Bam! And now if we go to manage, I can see my own pool. Obviously, I'm managing an impressive amount, $0 currently, but we can change that. I can simply click on my fund, Gorilla Fund, and fund my own pool. So we will put a small amount of money in there, deposit, confirm, we refresh, and now we see the Gorilla Fund here, the available dApps for managing assets. So we can choose some here. Let me explain in a second. Here we see the portfolio. So currently we're just holding Wrapped Matic. For some of these currencies or tokens, only the wrapped version of the asset is available. And we see a performance, which obviously will look different as we start trading more and more. We can even post some posts here and have some helpful overview. And now what you see here, what's really great is you really get exactly the same interface as you used to from, for example, 1inch. So you click 1inch and you see it's the exact same interface. You can trade your assets here, or let's try Aave. You have exactly the same, right? So I don't use this one, for example. I like to use SushiSwap and Uniswap, but also here exactly the same interface. So it makes it really easy to trade and invest assets.